Someone just told me they're selling their silver at $68 because they're scared the price is heading lower. And honestly, I want to thank them. Not in a sarcastic way, I mean it genuinely. Whoever is offloading physical silver at 68 right now is handing it directly to buyers in Singapore, Shanghai, and Mumbai, who are going to look back at this moment and smile. So thank you for your service. The vault doesn't drain itself. I'm JON AG. Drop one word in the comments, bullish or confused, and let's get into what's actually happening. Silver is sitting at 68. Gold is at 4,494. The gold to silver ratio is around 66-1, which is the highest reading of this entire market cycle. Gold just posted its worst weekly performance since September 2011. Silver recorded its third consecutive weekly loss, shedding more than 14% in a single week. The mainstream financial press is already writing the eulogy for the precious metals bull run. Meanwhile, the COMEX Depository report from Friday, March 20th, with an activity date of March 19th, shows the combined COMEX silver vault sitting at 332,695,254 ounces. 2 weeks ago, that number was 344,324,823. The week before that, it was 349,145,000. The vault is still draining. While every paper price headline is screaming capitulation, physical metal keeps walking out the door. Those two things are happening at the exact same time, and almost no one is connecting them. Let me share something that was published on CNBC on March 20th. Arthur Parish, a metals analyst at SP Angel, said this about the current selling. The generalist funds, the systematic hedge funds, and the retail momentum chasers who came in chasing the bull run, that money has no long-term commitment to gold or silver positioning. They're exiting now. And then he said something crucial, that this exit is probably exactly what's needed before gold can take another leg higher. A professional analyst speaking to a mainstream financial audience on a day when gold is making multi-week lows is saying the current sell-off is not the death of the bull market. He's saying it's the necessary clearing of the weak-handed participants before the next move up. He's not saying this on a gold newsletter. He's not saying it on a silver YouTube channel. He's saying it on CNBC. That's what intellectual honesty in this market looks like. The thesis is still standing. The tourists are leaving. Those are two separate facts that both happen to be true simultaneously. Now let's walk through the depository report, because those numbers are the only ones that truly matter today. And they're telling a completely different story than what the price chart is showing. The Friday, March 20th report shows Brinks pulling 616,162 ounces out of eligible. That metal physically left the vault. Manfra, Tordella, and Brooks withdrew 1,413,221 ounces from eligible. Delaware pulled 969 ounces out. CNT received 40,890 ounces into eligible. The net result, total eligible silver dropped by 1,989,463 ounces in a single session. Total registered was essentially flat, down about 212,000 ounces through adjustments at Asahi, HSBC, and StoneX. Combined vault, 332,695,254 ounces, nearly 2 million fewer than the day before. Here's what that means in plain terms. On a day when the paper price was falling, when the headlines were full of margin call language and forced deleveraging narratives, approximately 2 million physical ounces left the COMEX system. They didn't disappear. They moved to private hands, refiners, industrial buyers, institutional storage outside the exchange. The paper sellers set the price. The physical buyers took the metal. That's always how it works. The COMEX gold to silver inventory ratio right now stands at 1 to 10.4. For every ounce of gold in the combined vault, there are 10.4 ounces of silver. But look at the registered-only ratio. the metal that actually backs up delivery obligations, and that number is 1 to 4.8. These figures are historically extreme. They reflect a silver market that, at the physical level, is significantly more strained than gold relative to what's owed on paper. The paper price is telling you that silver has gotten cheaper relative to gold, with the GSR at 66 to 1. The physical vault ratio is telling you the opposite. Silver is actually scarcer than gold at the deliverable level by a wide margin. One of those signals is right. The other is the paper market behaving exactly the way paper markets behave when leveraged positions unwind. Now let me give you the full picture of what this week actually was, because I think it matters to name the specific mechanisms rather than leaving them vague. Gold dropped about 9.6%, its worst weekly print since September 2011. Silver fell more than 14%. Both metals faced simultaneous pressure from three distinct forces. First, the FOMC held rates steady with language that markets read as higher for longer, which immediately reduces the appeal of non-yielding assets to momentum traders who built their positions betting on rate-cut-driven rallies. Second, the Iran conflict pushed oil toward $110 per barrel, creating a specific paradox. Oil-driven inflation should be bullish for hard assets, but the simultaneous fear of economic slowdown drove risk-off dollar demand that hammered metals in paper terms. Third, and this one is the most significant by magnitude, the forced deleveraging of the leveraged paper longs who loaded up during the January euphoria phase has been unwinding in successive waves of margin-triggered selling. Parish laid out the mechanism precisely. The generalist institutions and systematic funds entered the gold and silver rally in 2025 because the momentum was undeniable. Gold was up 66%. Silver was up 135%. Every macro podcast was recommending precious metals. Every financial newsletter was bullish. But broad-based retail enthusiasm and generalist institutional momentum money is not the same thing as the structural central bank and physical industrial demand that drives long-duration bull markets. Momentum money follows momentum, and when momentum flips, momentum money exits, not because the thesis changed, but because the momentum stopped. These two groups, structural buyers and momentum traders, entered the same market at different times and for completely different reasons. The current correction is separating them. The momentum crowd is heading for the exit. The structural buyers have not moved. Here's the clearest evidence that the structural buyers are still in the market. The COMEX combined vault is at 332 million ounces and falling. If structural physical demand had retreated, the drain rate would slow. The gold to silver inventory ratio is still at 1 to 10.4, an extreme reading that reflects ongoing silver-specific physical demand. The March delivery count reached 41,500,000 ounces. That doesn't happen because momentum traders took delivery. That happens because buyers who wanted actual metal, not paper exposure, stood for delivery and took it home. The cumulative picture is this. The paper price is accurately reflecting where the momentum community has repositioned. The vault data is accurately reflecting what the structural physical community is doing. Those two signals aren't contradicting each other. They're both correct about different populations of participants. When the momentum crowd finishes exiting, the paper price will be left reflecting only structural demand. And structural demand hasn't budged. Now let me give you the honest version of what the near term looks like, because this channel has to be willing to say the uncomfortable things clearly. There is no certainty about where the floor is. Gold at $4,494 and silver at $68 are the current levels. The technical support zones analysts have cited, $70 for silver and $4,200 for gold, have already been tested and breached intraday in some sessions. If the deleveraging isn't finished, if more margin calls hit the systematic funds that haven't fully unwound, if the oil shock keeps feeding dollar demand, lower prices remain possible. Silver at $60 or below cannot be ruled out in the short term. That's not a forecast. It's an honest description of the uncertainty. What the physical data tells you is not the short-term floor. It tells you the fundamental value relative to what the paper market is pricing. And right now, $68 silver against a COMEX vault that's lost nearly 200 million ounces in 3 months. With May 1st notice day 41 days out, the registered pool sitting at roughly 79 million ounces, and May open interest still north of 380 million, represents a paper price that is deeply disconnected from physical reality. That disconnection resolves. It always resolves. The question is whether we're at peak forced capitulation or whether more deleveraging is still coming. Nobody can answer that in real time. What the data does tell you is that each day of forced selling is a day closer to the end of the forced selling phase. And when that phase ends, the price at which it ended is the price at which physical buyers were accumulating metal they believe is deeply undervalued relative to the real market. The buyers in China who didn't flinch during gold's last correction, who sold 600 kilograms in 60 seconds when inventory opened at 9 in the morning, are the same buyers who are perfectly happy to receive silver at $68. They are not watching the paper chart. They are watching the vault chart. And the vault chart says metal is getting scarcer faster than any paper price move can reverse. Cumulative CPI from 2016 to 2025 is documented at 35.7%. Gold over the same period is up 308.7%. The people who held through every correction across that decade are ahead by a margin that makes the current volatility look like a rounding error. Not because they were expert traders, but because they understood that the paper price and the fundamental value are different things, and that over long enough time horizons, fundamental value wins. That principle hasn't changed at $68 silver. May 1st notice day is 41 days away. The registered vault is at approximately 79 million ounces. May open interest is above 380 million. The math has not changed. The math does not respond to the futures price. The registered vault doesn't rebuild itself because paper silver got cheaper. The delivery obligations are still on the books. The momentum is gone. The structural thesis is intact. A physical drain continues. The tourists are leaving through one door while the fundamental buyers walk in through the other, picking up metal at a lower price that the tourists decided they no longer wanted. Let me go deeper on the SP Angel framework because I think it contains the most useful lens for understanding what comes next, and it's being completely ignored in all the noise around price action. Parish identified 3 distinct participant populations in the 2025 precious metals bull market. First, central banks, the group that drove the original leg beginning in 2022 after Russia's reserves were frozen. Second, institutional generalists and systematic funds who entered during 2025 as the momentum became undeniable. Third, retail investors who arrived during the final euphoria phase as the narrative reached saturation across every financial media platform. Each of those 3 groups entered at different price levels for different reasons, with different holding capacity and completely different responses to volatility. The central banks are still buying. World Gold Council data through the most recently available period shows central bank purchases running at approximately 750,000 to 1,000 metric tons per year, dramatically above the pre-2022 baseline of 400 to 500 tons annually. That structural bid has not reversed. No central bank announced a gold selling program this week. No sovereign wealth fund liquidated reserves because the paper price dropped. The institution that drove the first leg is still in the market. The generalists and systematic funds are the ones leaving. Parish said explicitly they have no long-term commitment to precious metals positioning. These accounts amplified the January move toward $5,600 gold and $121 silver, and they're now unwinding because momentum reversal triggers their models. Systematic trend-following funds are rules-based. When the trend breaks below a threshold, they exit, not because they've changed their view on the thesis, but because their risk protocols tell them to. These are mechanical sellers, not conviction-based sellers. The retail buyers who came in during the final phase are selling because they're afraid. They saw the January all-time highs. They bought near the top because the narrative was everywhere. Now they're experiencing their first major drawdown, and the fear is overwhelming the thesis. But this cohort selling has a ceiling. There are only so many retail buyers who entered near the top. As they exit, the selling pressure from this group exhausts itself. When all three exit waves have run their course, what remains is the structural bid from central banks, from physical industrial users who need silver for solar panels, EVs, and AI infrastructure, regardless of the paper price, from institutional accounts that build positions around physical scarcity rather than momentum, and from ongoing physical accumulation across Asia. That is a fundamentally different market than what existed in January, one with less speculative froth, less leverage, and a registered vault that has continued draining throughout the entire correction. Think about it this way. The momentum traders are the gasoline that made the fire burn visibly. The structural physical supply deficit is the wood underneath. Gasoline burns fast and dramatically. Wood burns slow and for a long time. The gasoline is burning off right now. The wood is still there. It didn't get wetter because the gasoline caught fire. Now stick with me here on the gold to silver ratio at 66:1, because I think it's carrying information that's getting buried in all the noise around the absolute price decline. This ratio peaked in the current cycle at around 90:1 in late 2022, during the post-pandemic consolidation. It compressed sharply as the bull market accelerated, reaching approximately 42:1 in January 2026, when silver hit $121. Now it's expanded back to 66:1, because silver has fallen harder than gold in percentage terms. Gold is down roughly 20% from its January high, while silver is down about 44%. That means relative to gold, silver is now priced at the cheapest level since before this bull cycle gained real traction. The thesis that drove silver from $34 to $121, the physical scarcity thesis, the lease rate thesis, the vault drain thesis, the May delivery math, none of it has changed. What changed is that silver's greater volatility amplified the downside move, and the ratio expanded back toward its historical range. This is the exact same dynamic that played out in every prior correction within this cycle. Silver falls faster and further than gold. Then, silver recovers faster and further than gold. The ratio oscillates around a compressing trend line where each cycle's peak and trough are progressively tighter than the one before. At 42:1 in January, silver was pricing its physical scarcity at a premium to its relationship with gold. At 66:1 today, silver is pricing that same physical scarcity at a discount to where the physical data says it should be. That discount will close when the selling exhausts itself, exactly the way it closed after February's correction. Let me now give you the specific data points I'm watching to identify when a floor is actually forming, because that's the most actionable thing I can offer right now. The first indicator is COMEX silver futures open interest. As leveraged positions get closed, open interest has been declining. When it stops falling and begins to stabilize, that signals the forced deleveraging of leveraged positions is nearing completion. No single data point more reliably marks the end of a deleveraging phase than open interest stabilization. The second indicator is the lease rate. If it spikes during the final flush, it signals that physical holders are being asked to lend their metal into a market scrambling to cover short-term delivery obligations. A classic bottom signal, where physical stress amplifies exactly when the paper market is most bearish. If instead the lease rate drifts toward zero, it would indicate easing physical stress, suggesting the correction could be more durable. Given that 2 million ounces per day are still leaving the combined vault, a lease rate collapse towards zero seems unlikely. The third indicator is the Shanghai premium. If it compresses during the sell-off and then starts widening again, that tells you Eastern physical demand is picking up at the lower paper prices. A widening premium during a paper sell-off is one of the clearest signals that the physical floor is being reinforced, even as the futures market declines. The fourth indicator is the depository report itself. If the daily drain rate slows materially, more sessions that look like the CNT 40,000 ounce inflow and fewer that look like the MTB 1.4 million ounce withdrawal, that signals selling pressure is starting to exhaust itself. A stabilizing vault level, even before it actually recovers, is an early sign that the correction phase is winding down. None of these indicators are flashing a bottom signal today. Open interest is still falling. The vault is still draining at significant rates. The Shanghai premium data is mixed. The lease rate is elevated, but not spiking to indicate acute delivery stress. We're somewhere inside the correction process, not demonstrably at the end of it. That's the honest answer. It's consistent with both near-term downside and a structurally intact fundamental thesis. Both of those things can be true at the same time, and right now, they are. What is not uncertain is the resolution. The vault will not refill itself. The May delivery math will not improve on its own. The structural demand from solar, EV, and AI industrial buyers will not vanish because the paper price fell 44% from its peak. The correction is temporary. The underlying structure is permanent. The timeline is unknown. The direction is not. Here's something else nobody in this space is talking about, and it requires stepping back from the price action entirely to look at the structural picture from altitude. CPI from 2016 to 2025 compounded to 35.7% cumulative. Gold over the same period is up 308.7%. That's not luck. That's the same structural mechanism that's operated throughout monetary history. When the currency depreciates, hard assets whose supply is constrained by geology rather than by printing press decisions outperform the depreciating unit of account over time. The 308% versus 35.7% divergence is the sound money thesis executing exactly the way the historical record predicts. Silver over the same period has also dramatically outperformed cumulative inflation, though with considerably more volatility than gold. The people who held through every intermediate correction during that decade, through every paper sell-off, through every mainstream media obituary for the bull market, are still significantly ahead of the inflation rate that eroded the purchasing power of everyone who stayed in cash. The current correction doesn't change that record. It extends the period of volatility that anyone who held through the full cycle already knows comes with this asset class. Someone who bought silver at 35 in 2024 and is watching 68 today is still up approximately 94% from their entry point, despite the correction from 121. That's not a loss. That's a volatile bull market doing what volatile bull markets do, giving back a portion of gains before the next leg, while the underlying physical drivers keep accumulating pressure. The buyers who got in near the 121 high in January are experiencing a genuinely painful drawdown. 44% from peak is uncomfortable, no matter how strong your conviction. But the thesis determines whether that drawdown is a permanent loss or a temporary setback. If the thesis is wrong, it's a loss. If the thesis is intact, it's an opportunity to average down or to hold through the volatility to the next leg. The vault data, the lease rate, the delivery counts, the Singapore queues, the SP Angel Analyst saying on CNBC that tourists exiting is what's needed for the next leg higher. All of it points toward the thesis being intact. Let me also make sure you understand the significance of the COMEX gold to silver registered ratio at 1 to 4.8, because I don't think this number is getting the attention it deserves. The registered vault, the metal that can actually be used to satisfy a futures delivery notice, holds gold and silver at a ratio of 1 ounce of gold for every 4.8 ounces of silver. That might sound like a lot of silver, but compare it to the paper market. May silver open interest represents 380 million ounces of paper silver. The paper to registered ratio in silver is dramatically higher than in gold. The delivery risk in silver is structurally more concentrated than in gold, even though the absolute registered inventory is larger in silver terms. Now compare that 1 to 4.8 registered ratio to the geological production ratio, which runs approximately 8 to 1 silver to gold. The COMEX registered vault holds silver at less than 60% of the rate that geology produces it relative to gold. That reflects years of silver consumption reducing above-ground stocks faster than they're being replenished. The geological 8 to 1 ratio is the fundamental anchor for what equilibrium looks like. The registered 4.8 to 1 says the market is running at about 60% of equilibrium on a production-weighted basis. That's physical scarcity at the institutional level expressed as a ratio. The paper price at $68 with a GSR of 66 to 1 says silver is abundant relative to gold by the standard of how many ounces it takes to buy an ounce of gold. The registered vault ratio says silver is scarce relative to gold by the standard of what's actually available to honor delivery obligations. Those two signals are pointing in opposite directions. One uses the price mechanism currently dominated by leveraged paper selling. The other uses the physical vault dominated by irreversible physical drain. Over time, the physical reality wins over the paper signal. It always has. We are watching, in real time, the most comprehensive stress test of a physical silver delivery system that has occurred in the modern era. The COMEX registered vault was at 240 million ounces in 2020. It's now at 79 million. That reduction happened through 3 years of structural industrial deficit, combined with the delivery mechanics of the most active physical demand cycle since 1980. The paper price went from 34 to 121 and is now at 68. Both the run-up and the drawdown were driven primarily by paper market dynamics. Momentum on the way up, forced deleveraging on the way down. The vault drain continued through both moves, indifferent to the paper price, responding only to the fundamental reality of physical demand exceeding physical supply. By May 30th of this year, the April contract will have closed, and the May contract will have moved through its full delivery cycle. The registered vault at that point will reflect how much metal the current correction's physical buyers accumulated versus how much the ongoing drain removed. The May delivery demand will be determined by how many of those 380 million ounces of paper outstanding choose to stand for delivery. The resolution of those two variables against each other is what this entire year has been building toward. $68 silver is a price. The vault drain is a fact. May 1st notice day is 41 days away. The tourists are leaving. The physical buyers are staying. The wood is still burning. One word in the comments, bullish or confused. If this channel has been useful to you during the most sustained precious metals correction in years, hit subscribe and turn on the notification bell, because when the tourists have fully cleared out and structural demand reasserts itself, that's when this data is going to matter most. I'm Jon Ag. The vault keeps draining.